My name is Malia Russell. To my left is Matt Hewitt.
Matt's name, synonymous with Bain. He started his investing career at Bain Capital in 1995, and after a spell away, rejoined on the venture side in 2012. He sits on the board today of Boston's very own Flywire, which IPO'd in 2021. Hans Morris knows the fintech industry inside out. His former roles include president of Visa and CFO of markets and banking at Citigroup. And since 2014, Hans has been managing partner of Nika, a fintech-focused investing firm. And he is chairman of the board of Lending Club. And last but certainly not least is Jillian Williams, who's the fintech engine of Cowboy Ventures, a seed-focused investing firm founded by renowned investor Eileen Lee. Jillian joined in 2021 from Anthemis to expand the firm's fintech footprint and has worked closely with such startups as Pipe, Maxwell, and TrueLayer. So I was reflecting with our panelists backstage that I hosted this panel last year on fintech, kind of where are we now and where are we headed, and the mood then was markedly bleak. We were talking about funding being harder to come by and startups marching toward this mass extinction. And we're here to kind of flip the script a little bit today, and hopefully you come away feeling more optimistic about fintech's future. So Hans, I'd love to start with a little bit of table setting for the audience. We've seemed to kind of hit this plateau, I think, in fintech, which gives us some optimism that we're the worst is behind us. But can you take us back 5 years or so, not all the way to the dot-com bubble, but maybe in the last 5 years, what's been going on in fintech that brought us to these doldrums that we're maybe just now getting out of?
Well, I'd say 2019 and 2021 was pretty much the peak fintech. And I think a lot of it has to do with really mispricing of risk. So investors were, because of interest rates are very low, and there were many exogenous trends, particularly the pandemic, which suddenly made a lot of like payments and other applications very, very timely and attractive. And so investors had lots and lots of cash, and so there's a general feeling of FOMO among all different asset classes. People who had not participated in fintech before as investors, and in some cases didn't have really clear understandings of some of the issues and risks, still wanted to invest in them. So there was overabundant capital. I mean, the volume of financings went up, probably five-fold or so, and I think what that led to many entrepreneurs not managing their assets very well. So the narrative, which many of us, I'm not sure we all shared it equally, but there was certainly the dominant narrative was, if you are growing, don't worry about deficits. They're not relevant. You can finance those deficits. It's just growth. And I think that then was shockingly changed. And I think companies went public with that, believing that they didn't need to worry about deficits. And so that required really a very dramatic restructuring of all these public companies. There's 71 that went public in that period, 2020 to 22, fintech companies. So massive restructuring of those companies, make them more profitable. Then, you may remember there was a series of exogenous shocks. One was interest rates going up, but the other one was there were many regulatory developments which were inhospitable to fintech. And one was Silicon Valley Bank, the funding crisis they went through suddenly made the cost of deposits much more clear. Then we had the bank as a service model basically fall apart with the Synapse bankruptcy. And so many models that depended on having a banking license or having access to deposits or access to credit failed. Many business models that really were only a function of zero interest rates, like all the prop tech things and free options on 30-year mortgages and real estate and all that doesn't really make sense when you examine it with risk properly priced.
I remember covering the way funding to startup tanked in 2022 and 2023, and even then, as we were seeing the whole tech ecosystem kind of like quaking in its shoes, the problems in fintech felt particularly acute. What I'm hearing from you is like, one, you had a lot of kind of tourist investors coming in who maybe didn't understand the models here. And
Too much capital.
Too much capital. And second being this kind of correction maybe from after Silicon Valley Bank and other. Can you spell that a little bit more? Like, what is the repercussion?
You guys can all chime in.
Yeah.
These are familiar. We're all very familiar with these problems.
Yes, super painfully familiar with these problems. I think to illustrate and parameterize the increase in fintech funding, there were two things going on. One is venture capital funding went up a lot. So I'm familiar with the numbers from 2012, which was when, as you mentioned, I rejoined Bain Capital. There's $70 billion of venture capital in 2012. That went up to $350 billion in 2021. So a 5x increase just in the dollars of venture capital. Fintech was 2% of the market in 2012, and it was 20% of the market in 2021. So that's a 10x increase multiplied by a 5x increase. And you had a 50x increase in the dollars of fintech funding. And I think anybody who just looked at that on a page would be like, well, that's probably not going to end well. And it surely didn't. I think the second thing, and one of the reasons behind that 50x increase is a lot of these investors who are new to the space, the more money a company was raising, the better. It wasn't just sort of a neutral or negative factor. It was actually, if you're SoftBank or any hedge fund, I won't name, you're raising $150 million? Well, I have a lot of money to put to work. We can do business here. And the thing about lending companies and insurance companies and prop tech companies is they need like infinity money. And if they double, they need, double infinity money. And so there was like an unholy marriage of deep pockets looking to deploy and really bad business models that needed massive amounts of capital. So that, I hope, is like a once-in-a-lifetime kind of nonsense thing, but it takes years to recover from that sort of thing.
Jillian, you joined in 2021, is that right?
No, so I've been in the venture space since 2016, specifically focused on fintech as well. And so just to kind of highlight something that Hans mentioned as well, was like the problem with fintech as well that kind of compounded all of this was like a lot of the business models were really only ripe for a specific point in time. Like a lot of them depended on low interest rates. So a lot of the prop tech, the real estate, the lending only really worked because of being able to lend at low interest rates and that they were actually able to get that cost of capital for really low. Same with the ability for a lot of even like consumer bank accounts to be able to have these really low deposit rates. And so when all of those dynamics started to change, that changed completely. And then also with a lot of this increase in capital into both fintech, but then also the venture market, as Matt mentioned, people were investing a lot more. And so the idea of just growth at all costs, there was a little bit less rigor around like, okay, you have to make money off of that, which isn't great, obviously, but just like, okay, you're getting tons of users. And so a lot of people didn't necessarily care as much around like, how you were going to make money today, but that was kind of a tomorrow problem. And so when that changed, that became a bigger problem as well, where it's like, oh wait, these unit economics don't actually work, not only in today's market, but especially not in tomorrow's market as well. And so kind of it was really just like a perfect storm of everything happening at once that hurt all of the venture ecosystem, but hurt fintech specifically even more.
So when did we kind of run up against the wake-up call, or when did you start to see that in your own portfolio?
I'd say 2022, it's maybe, I'm trying trying to think of probably like February-ish 2022 is when you started to be like, all right, like clearly, maybe a little earlier, but that was when it was like, all right, like you can clearly see
Buckle up.
things. Yeah, and then that was when it really started to shift. But I'd say like around early 2022 is really when you noticed this shift. And some of it was just a lot more drastic to fintech because of how much money went into it, where honestly, initially, it just went back to what like the funding was in 2019, but because of how much it had grown, it seemed like it was such a huge shift, and that like, oh, fintech is completely dead, when really it was like, it just went back to maybe a little bit more of a rational amount that was probably more normal, but that was a huge shift, and so it looked like it was terrible compared to everything else. But it really did mean that people had to like figure out their business models, that a lot of companies, you saw like Brex and Ramp both add software components to their businesses a lot more. And people had to kind of really rethink how they were building their businesses a lot more capital efficiently, but also in terms of how they were charging and what they were doing in terms of how they're actually operating.
One other thing about 2022 that's worth noting is anyone who was doing fintech probably was like at least a little crypto curious. And 2022 was, I mean, it was the worst year in crypto. It was the worst year in anything I've ever seen. And it was certainly the worst year in crypto. And it went from starting that year with this kind of obscure Terra Luna debacle that no one was paying attention to, and then Three Arrows goes out of business in March, and then all the way straight through to FTX blowing up that fall. And so this is all happening in the next neighborhood over from fintech. And it all felt like part of the same calamity.
We had an LP meeting in October 2021, and everything was just, we feel really, really brilliant. We're showing all these fantastic graphs. We're saying, look at all these trends. And I had one slide that said, the world loves fintech, or something like, there's all your chance in fintech, and we do fintech. What I think was, what could possibly go wrong? And so we made a list of 10 things that could go wrong. And one was major liquidity crisis, war in, one of the various hotspots, an FTX, not FTX, but a crypto exchange blow up. A major money laundering scheme in some of the fintech companies, inability to fund some of the large marketplace lenders, a corporate bankruptcy, an unexpected corporate bankruptcy, a bank failure. So we listed all these things. 1 year later, at that conference, I said 9 out of the 10 things happened. So it's just like, hey, it was just what I said about mispricing risks. These people were paying, the risks were obvious, rates were going to go up. Everyone, you could see that, and yet people.
I think you have a future in sports betting. But.
Could you please not make a list again?
So Jillian, you were talking about how a lot of companies were seeing that their models needed to be reimagined, and the place I want to head to next is, how did companies respond given these new constraints, given that funding was scarce, given that it was harder to sell into enterprises? Was this something that companies could pivot to correct, or was this we just have to say goodbye to these companies and move forward with the seedlings that have, fresh runway ahead of them?
I think it's been a combination, honestly, and I think what you saw at first was, first of all, VCs love to be a little bit dramatic, and so I think you first saw everybody hit the panic button. I think that's also partially what happened with SVB, but you saw them hit the panic button and chat with all their portfolio companies around how do you make your runway last X amount longer, and what does that look, and focus more on sustainable growth rather than growth at all costs, and really rethinking how they're building. And so you saw people first kind of do that, and then really rethink, okay, is this something that how can you improve your business model? How can we actually get to the point where there can be real growth? And I think one of the other challenges is that there were a lot of nice to have businesses. I think in the time when there was so much surplus budget at a lot of companies, consumers honestly like the weirdest thing about the pandemic is that consumers had a lot more money, like savings were like the highest that they've ever been. So people were able to spend money a lot differently than they are today. So that was very different. And so from enterprise budgets and consumer budgets, like it went from like being able to spend on nice to haves to need to haves. And so rethinking businesses a lot to making sure that everything was a need to have. And you had to confront that question with a lot of these businesses. And like there are some that were able to pivot and move into that and add what they needed to do to make sure they fit that bucket and make sure they were able to do that. And then there are some that are not able to do that. Some of those are probably still alive today because they may have gotten a lot of extensions and things like that because didn't want to let them die. And some of them, some returned capital and some might be pittering out. And there's different stages of what that still looks like today. I think you'll see a lot more of that kind of continue to flush out throughout this year. I think like 2 years out is probably nearing the end of that, but I think you can continue to see what that looks like. And others got honestly a lot stronger post that. Because once you figured out how to like grow sustainably, you were able to really like recapitalize or like stand out from the crowd a lot better and then raise off of that.
You know, I think one thing in that we talk about a lot is there's certain categories of fintech that are hard to fund. And that has always been true to some extent. We do a lot of capital markets investing, and Matt used to do a lot of capital markets investing, but not many.
I don't miss it that much.
Yeah, not many venture firms do capital markets fintech. And one risk is you go, well, this is really interesting. We know a lot about it. We can help them, but it's going to be really hard for them to raise a Series B, even if the company is doing well, because 95% of fintech investors say, well, we don't do that. And I think InsurTech was another area where the InsurTech companies were terrible. And the companies that went public did terribly. Stocks are up 100% this year. And some of the, I think there's a lot of lessons learned, so it's better. But I think it also turns many investors off of sectors. So the liquidity, the ability to raise a Series B, which I think is one of the toughest things to do now, that is, you have to think about that in your risk assessment when you're doing a seed or an A investment.
I mean, just to add to that, if you think about the companies that are hopefully on the docket to go public next year, a huge portion of them are fintech companies. Like you have Klarna, you have Stripe, you have Navan, Chime. Like there's a good portion of really strong fintech companies that are hopefully, as the IPO market finally opens up, like are going to go public. And so you've seen ones that have really rebounded and actually are making up a good portion of the overall tech market that is ready.
Matt, do you think we're headed for like a fintech renaissance?
I do. I mean, from this new lower base, I think we have a lot of headroom to go. And I think the hope that I think you're kind of hearing implicitly and explicitly on the panel is that some of the lessons learned will be remembered around capital intensity, around resilience to macroeconomic factors. One of the other things I would throw in there that I think is really worth remembering is there are a lot of the high growth companies in 2020, 2021 were startups selling to other startups. And this is like a real danger sign, and throughout my career, is that it's a very sort of like pro-cyclical thing to do. And it really, really works until then it really, really doesn't. And so even companies like Carta or Plaid, two great companies, like their growth rates really slowed down because they were selling to startups. In the case of Plaid, it was like fintech selling to fintech. And so when you have a slowdown in fintech, you have huge churn, a bunch of your customers cutting costs, and you have way slower new customer formation. And we had companies, we went through and did a review of our later stage portfolio. Averagely, our companies were using 80 different SaaS tools. I mean, it was just sort of like open to buy. Anyone could start using a new marketing tool. Let's see if this adds value. And we never got around to canceling that subscription. And so we would just go through and like kind of cut half the subscriptions and just be fine. So there was this way in which like Brex was everybody's first customer. Basically, they were like their procurement department was just an open door. And that is fine until it's not. So I think there's a long list of things that in terms of like high quality company building, I think people in fintech and in the venture ecosystem more broadly will keep in mind.
I'm going to add to that in an important way on enterprise. I think, I'm not sure, but I think NICA probably does more fintech enterprise than any other firm, which may not be a good thing at all, by the way, but we do a lot of it. And I believe in it. My last job at Citigroup, I was technology operations finance, reported to me, and I can tell you, you're replacing tools that have been there for 30 or more years, and it's a very complex environment, and so things that really solve a problem stay in there for a long time. But it is a really long sales cycle, and it's gotten much harder because the things we were talking about earlier about, they had the same thing. They were trying how many, different, RBA processes, tools, and they may have 20 of them at Wells Fargo, and they're consolidating them all. They want to have one or a few. So all that is going on. Fintech selling into large enterprises had a really tough 2023-24. And I also think that the risk assumption that companies have been going through, because Roostify, kind of a high flyer with Blend in mortgage origination technology, and that got sold, ran out of cash, got sold to CoreLogic. CoreLogic discontinued some of the core applications, and the big enterprises saying, well, hold on, we're using this for our mobile mortgage application. So the risk assumption that large enterprises are using in evaluating fintech has increased. And so that I think entrepreneurs need to be aware that you need to be thinking of building a company that will meet high standards for engagement. So that's another thing which is major change in the last couple of years.
And this brings us to kind of the relationships that fintechs are having with the incumbent financial institutions, right? What kind of lessons learned have you seen out of Silicon Valley banking crisis, and how? And I suppose the can you spell out the middleware argument for me again?
Synapse?
Yes.
Oh yeah, sure. We're supposed to be getting to the fun part, or this is going to delay that a little bit. But yeah, so I mean, Silicon Valley Bank is, I think, the first chapter in what's going to be a long and problematic story of just deposit stickiness not being what it always was. It's a particular example which is unlikely to be exactly replicated, where basically all of the customers of one particular financial institution could coordinate through the fact that the venture industry was involved in all these companies, and so one WhatsApp channel ruined a bank in 36 hours. So that's not likely to happen to Truist Bank or whatever. But I think the fact is that there is more information in the world, and latency has gone down. You can move money more quickly. And so I think one of the things the banking industry has to reckon with is that the sort of maturity transformation of being able to count on your deposits being there for a long time is going to come into question.
You know what? The deposit data, 1 year, after Silicon Valley Bank, it's completely stabilized and go back to norms, and deposit betas haven't changed that much. And so I felt there, everyone said that, but then you look at the data, it hasn't really happened. So
I think generative AI changes that, by the way, but this is a longer conversation. Synapse, banking as a service is, like, for all intents and purposes, dead. Because this company, Synapse, had basically ledgers that didn't reconcile, and so all these fintech companies told their customers they had X, and Synapse said, no, you've got Y, and the bank underneath said, actually, it's Z. And that is 6 months into a messy public litigation, as yet unresolved, tens of millions of dollars that customers thought they had, unreturned to them. Personal bankruptcies, all sorts of horrible things happening. The regulators are going to be paying attention to that for the next 5 years, and they're going to be making life much harder for anyone in banking as a service. Or just trying to be a neobank, frankly. I think most of the neobanks become banks or get sold.
So I think we've established now that we have returned to the pre-pandemic normal. I was just looking at some CB Insights data this morning that showed that I think total deal count in the fintech category, fundraising deals, had dropped to its lowest record since 2017, but you kind of marked that as like the beginning of the bull run we saw in fintech. And an interesting piece of the data was that there was more dollars going into fewer companies, and there seemed to be this real concentration of investor dollars into winning companies or maybe lower risk categories. So I'm curious to hear from you guys, like, where do you see most of the action happening in fintech right now? What are investors jumping out of their seat for, as we're coming out of this slow period?
How about AI?
There you go. That's what I was going to transition to. Well, obviously, like across the venture ecosystem, AI is something that everybody's very excited about. I think the way that we view it is it's like another tech layer that is just going to be integrated into almost every company, whether it's like a completely AI native company or a company that is integrating it. And so I think within fintech, there's like a lot of different subcategories of what we're excited about. You have, I think, financial services is a really interesting category where like a lot of businesses are more services heavy. And so AI can be a really interesting opportunity to productize that a lot more, make them exceptionally more efficient. So you're seeing a lot more of like AI-enabled accounting offerings, for example, that can make either accounting firms a lot more efficient and actually more venture scalable, or actually just like completely trying to automate aspects of accounting. We're also seeing that across different areas of like financial analysts. I've seen that across insurance. And so I think we're really looking at where are the enablers where there's interesting data sets that especially like you weren't able to access prior, and that with AI, you can actually continue to either get access to it or create new data that was just too unstructured or too messy or like too manual, honestly, to be able to access before. So we're really excited about that. And I think for us, a lot of that happens in like some of the like back office boring industries, and both horizontally and vertically.
I don't know that CFOs are known for being like the quickest to adopt new technologies. And so I was curious to hear from you guys, what has the reception been for your company's customers? Is this something that they are, racing to adopt, or are they seeing a lot of reluctance?
I mean, we spend a lot of time with CFOs, and I would say you're right. They generally are the people who go around saying no to everybody else's desire to add software, and so they themselves have a certain sense of responsibility not to be profligate. And yet, they're being asked to do a lot more. The CFO's job often was sort of, capital markets and accounting, but now there's a lot of financial planning and analysis, complex treasury, and frankly, more just broadly speaking, strategy. And so it used to be that they were just given an ERP system, basically a sort of gussied up accounting system, and that was all they got. And maybe they could add some modules for accounts receivable or something. But now they have the budget and the ROI to buy a bunch of solutions around that ERP. And so I'd say and generative AI helps here. Like Jillian said, in this case, it's a little bit more of like a tool in the toolkit than a defining characteristic of most of these companies. But we are definitely seeing growth and CFOs having a willingness to buy FP&A, financial planning and analysis tools that help them get more efficient in accounting, anything around accounts receivable and accounts payable. They can pay more slowly, collect more quickly, treasury management. When Silicon Valley Bank did set alarm bells going across the CFOs in all of our portfolios about the safety and security of all their deposits and where they happen to live. So it is actually a growth area, notwithstanding the fact that with that customer, you have to be able to prove value very concretely and in a very known time frame.
Jillian, I read a blog you'd done earlier this year, and you wrote about how AI not only offers opportunities to improve operations, but AI also introduces new and heightened risks for companies. But there was a silver lining that you wrote about. What was that?
Yeah, so it was maybe a little bit circular in the way where the example I'll give is like AI can obviously have a ton of value, but there's been risks around, there's like a company recently I was looking at around AI voice phishing. I think there was an article earlier, it might have been in January of this year, around I think it was someone below a CFO that actually almost released money because he was on the phone with who he thought was his CFO, who authorized him to send the money to someone, and it sounded exactly like his CFO, told him exactly what to do. And it wasn't until like the last final step that he figured something out, and it was something that the guy said that he realized it wasn't him. But everything about it sounded exactly like his CFO. And so AI voice phishing is becoming a greater and greater issue. And while that can be a challenge for all businesses, it's especially a challenge for regulated businesses. I remember speaking to folks at First Republic when they were still around, that wire fraud was their biggest loss, actually. And they're one of the banks that actually calls you to verify that you are the person and that you're sending it to the right person every single time. And so even things like that, it just becomes such a bigger issue. But then at the same time, AI can actually help improve a lot of compliance as well. There's been a lot of innovation around KYC, AML, et cetera, but we're still behind, and companies are still losing tons of money. Like TD Bank was just fined $3 billion like last week around like AML, and so there's still so much more that we can do within these spaces. And so there is a silver lining where, as much as like fraudsters are kind of always ahead, and AI actually is probably a benefit to them, it also can be a benefit to us to help improve our technology that we are able to use to catch up as well. And we've already seen some early companies that can help that as well.
Hans, are you making some AI investments? What's exciting to you right now?
Our theory, here's a good, the analogy I like using is a little bit like driverless cars. Like everyone said, it's happening, it's going to transform everything, and we're 10 years in after that Economist article said it's going to happen next year. And the reason is, I think, analogous because everything is regulated in financial services for a good reason. Everything. So the regulators, I actually went to an FSOC, FSOC, Financial Services Oversight Council, chaired by the Treasury Department, on AI with a whole bunch of regulators. And I came away going, wow, it's going to be a long time before there's regulatory clarity on this, because we have a very complex system. But even in the UK, where it's very simple, there's a lot of risks that they're focused on. And so if you're doing something saying, why don't we use AI for consumer credit underwriting? My view is that's a long way off. It's a lot that's got to be proven on data governance, controls, making sure that your AI engine is not discriminating further. If you're saying we're using it to combat fraud, should be pretty clear cut, but it is not. If you overlooked an AML and you didn't file a SAR when you should have because the machine said you didn't, believe me, you're going to get fined. It doesn't matter what your model did. Being able to, there's lots of problems in just AI in general that I think will get worked out. But if you think, suppose you're doing marketing and you say you're right 85% of the time, that would be very, very good marketing. If you're right on AML, false positives 85% of the time, that's a big problem for a highly regulated business. If you're wrong 85% of the time on sending out FINRA required customer notifications on some investment management thing, that's completely unacceptable. So our view is you're going to have the way we think about it is saying there's lots of very expensive people in financial services. We want to make them more efficient using AI, but you're making a person more efficient or something that is still that expert layer, which still has to have the responsibility to control it. So big opportunity, but I think like driverless cars, like it's overestimated when actual arrival in the way people are talking about it happens.
The way I think about it, is often like this kind of scale around risk and value, and we're still a lot more at like the low risk, low value in terms of where it's operating, and like honestly where maybe I feel more comfortable in terms of investing. Like if I think about risk, like probably not letting AI decide for itself if I have cancer, if it's looking at my screen. It's like probably need a human involved in that. Something that's life or death, you probably don't want them to do it. But right now, augmenting a human to review a radiology screen and working and doing, or just helping go through emails very quickly. Like I use an AI email bot to schedule meetings. If it messes that up, a little bit annoying, but that's pretty simple, and the value there is nice, but not the most valuable thing. I think where we still need to get is like where it's doing much higher value tasks. And then we're probably still pretty far away from where it's doing very high risk tasks, especially on its own.
True.
I'm curious, as your companies and founders are thinking about improving the efficiency of their organizations, are they piecing together open source models and building it themselves? Are they buying the software to improve their efficiency?
I think for departmental level efficiencies, like I would like my engineers to be more efficient. I would like my customer service to be more efficient. The off-the-shelf third-party tools are generally way better than what any one of our companies is going to be able to build themselves. And not to say that some haven't tried, because usually our companies are led by engineers and they think they can build everything. But the fact is, there's so much funding going into that set of companies that are these sort of horizontal, departmental level efficiency companies that it'd be very hard to kind of roll your own successfully in a way that's cheaper than just buying these tools. I think where it gets interesting is when it's less about these obvious like horizontal tools that apply to almost everyone and the things that are more bespoke to your company. And in financial services, there are hundreds of examples of this where you have basically people reading and writing all day. Like that's the job, is you look at these documents, and you compare them to that document, and you output a third document. That's like mortgage servicing or insurance claims processing or anything that has like a TPA. All those TPAs are just reading and writing, third-party administrators. So what we're seeing is where companies can do it themselves and should do it themselves, or when it's not something that's horizontally applicable to every company, but a little bit more specific to your field of endeavor. And the open source tools are amazing. Meta's tools in particular are just incredible and getting so much better, so fast. So it requires technical expertise, but we're seeing like shocking levels of performance improvement in these tasks that are fundamentally reading and writing based.
Okay, so what I'm hearing is I'm nowhere near like logging into my investment banking account and asking a co-pilot to like go do trades for me and maximize my earnings, or?
I would say nowhere near. I think wealth is like the last area to become automated. People have, I will say there's a little bit of a fallacy here. Like self-driving cars are already better than the average human driver.
That's part of the analogy too.
But it is not the threshold. People aren't saying like, is it better than the average, usually tired, sometimes drunk human? That is not the test. The test is it frickin' perfect? And so it's an unfair test that self-driving cars can't beat outside of controlled environments like San Francisco, but they're getting better. And I think the same is true for generative AI. It is better than humans, but that's not the threshold. It has to be like close to perfect. I think in 5 years you'll be saying like, wait, a human read my scans? Give it to the computer. It's no question that computers will be so much better than humans at so many of these high value tasks, but the regulatory and just sort of like ick factor of having these high value things decided only by computers will mean that there will be humans in the loop for a long, long time.
Well, are there any other areas out, maybe related to AI or not, that you're paying closer attention to right now, knowing what we know now?
Convergence of fraud, AML, crypto, and cyber where everything in fraud, you're right, that fraud is everywhere, and fraud and scams is getting more sophisticated. You have real-time payment systems in now 85 countries, and so the costs and implications of this are really high, yet all the systems are point systems, just picking a use case versus having a bigger picture look, and all this is highly interrelated. And so that is something that I think is a major, major topic to talk about next year for 4 hours. The whole conference will be devoted to that.
We're spending a huge amount of time on stablecoins. We have a crypto fund that we work closely with, and sort of our overlap in the Venn diagram are people using stablecoins outside the United States primarily to create dollar-denominated accounts on the blockchain, so or on one of various blockchains, but usually Ethereum or Solana. Because if you live in most other countries, you'd like to keep money in dollars, and it's hard to open a U.S. bank account, and it's easy to open a crypto account and buy USDC. So it has become a very popular way outside the U.S. for people to own a proxy for dollars, and then start moving that money around much less expensively than moving fiat currency. So stablecoins are growing fast outside the U.S., and then if you look at what BlackRock is doing in the U.S. with not just stablecoins, and not just the Bitcoin ETF, but also taking treasury and money market funds and putting those on the Ethereum blockchain. And so you can take your stable coins, convert them now into yielding tokenized assets, so-called real-world assets. All that stuff that was kind of a fantasy 2 and 3 years ago is now actually happening in 2024, and I think the implications are massive.
Well, we're starting to wrap up, and I imagine that if you came to a panel with VC in the title, there may be some of you in the audience who would like to know how to get money from any of these individuals. So I hoped you could each take 1 minute and share a piece of advice with a very, very, day zero early stage founder on what they can do or absolutely shouldn't do to raise, that first $1 million in seed funding.
I think maybe a not entirely intuitive part of our process is assessing founder market fit, or what I generally think of it in a less buzzwordy way as authenticity. So I think one thing to think about before you set out to raise capital is sort of the why me question. Why am I doing this, for one thing? What are my actual intentions, and how authentic are they? How much do I care about this problem? And too many times founders sit at a whiteboard and say, like, okay, we're going to do, Uber for what, for X or whatever, like totally inauthentic. And what we really strongly prefer is a big, big problem, but specifically one where you as the founder have a really distinctive reason why you're going to be the one to solve it.
I would, that's well put. And I'd also say the ability to describe the issue with precision and be able to explain how a go-to-market would really work, given the precise way of describe that problem, is usually terrible. And they can talk about the problem sometimes, but okay, and you can imagine a solution, but how do you get from here to there means that they have not thought about it enough. And that, to me, is a big issue.
Maybe they use ChatGPT to condense their answer.
No question.
Yeah, I think Matt said this, but team is really important to us. But another thing that we think about when we're assessing a team is, and this is a little bit harder, but it's like how quickly someone iterates and learns. And so something that I really like is like when you kind of bring me along a little bit in terms of how you've been thinking and how you've been on this journey. And so like some assumptions that you had, how you iterated on it, how you tested it, what was right, what was wrong, and just like how you have moved quickly in this process. And so I think that like understanding how you've come to some of the conclusions that you've come to is really valuable as well.
Thank you so much, guys. I think my takeaway...
Can I ask you a question, though?
Oh, God.
Why did you say taking off like a rocket? I'm not sure that's the analogy that we would...
Like a lot of rockets blow up on the
Exactly.
back.
We don't want... I don't know which one. I'm thinking maybe more
Think
like
of it,
a,
you're right.
a nice slow, a plane that's avoiding thunderstorms. That,
Yeah, this is like early SpaceX testing. Yeah, no, I didn't write the title, but I did. But my takeaway from this panel has been that there are certainly bright spots that are shining very brightly right now in fintech, and I think there's a lot of optimism to be had. Thank you all so much for joining us and coming out to New England this morning. Let's give them a round of applause.